Hey everyone, this is Wilson, and in this video, I'll be going over the PDT rule, the pattern day trader rule. This is a rule that a lot of traders hate, whether or not you're just a regular trader, a day trader, and it stops us from making our money, right? As traders, we want to make money, we want to take in profits quickly, especially when the stock jumps up and or cut your losses quickly, right? So this rule stops us from doing that. And in this video, I'll be going over what the PDT rule is and some quick workarounds that you can use and you can apply, especially if you're a smaller trader and you're just getting started and you're getting annoyed by this rule. Again, my name is Wilson, and you can follow me on Twitter at iswilson8. So, what exactly is the pattern day trader rule, right? PDT is what people call it, and the PDT rule limits the amount of day trades you can make in a day or in a week. This applies to pretty much all brokerages, so like E-Trade, Robinhood, pretty much any type of brokerage. The big brokerages that are based in USA, and it's required by law, so it's a part of the SECs, and they stop you from day trading, right? It's limited to a 3-day trades per week. So we know that the market opens about 5 days a week, and during those 5 days, you can only make 3-day trades, or else your account will be restricted. People hate this rule. As I mentioned, day traders hate this rule, or people that's trying to make money in the stock market hates this rule. I hate the rule. I'm over it now because my account has grew to the balance where I don't need to worry about it anymore. But in the beginning, man, I hated this rule because a lot of times I'm trying to cut my losses or I'm trying to take my profits before the stock tanks, especially if I'm trading penny stocks on a day-to-day basis. This rule stops me from doing that. And there's a lot of penalties. It really depends on your brokerage, how long you have the account for, and how much capital you have in the account. But penalties could be as simple as just an email, a warning, a phone call, or it could be a 90-day restriction, which is not what we want. We don't want the 90-day restrictions because it won't allow you to trade unless your funds clear. And it's something I hate. So I decided to make this video to teach you guys some workarounds. So let's briefly, just quickly go over what is considered day trade. I'm pretty sure most of you guys already know, especially if you're watching this video and you're already into trading. But any buy or sell trade executed in the same day, right? So if you buy a stock in the morning when the market opens, it spikes up, you want to take your profit and you sell it, that's considered a day trade. Vice versa, if you're losing money and then you decide to sell the stock to cut your losses, that's considered a day trade. So swing trading, where you hold overnight, or for multiple days, is not considered to be a day trade. So if I buy today when the market opens and then I wait until tomorrow to sell, that is not considered to be a day trade. Or if you wait 3 or 5 days or a week, that's not considered a day trade. Funds still take time to settle, so the T plus 3 days rule still apply for most brokers, right? And that means that if you're trading today and you sell the stock, so you make the day trade today, your funds won't clear and you won't have the buying power until 3 days later. So this is a problem already to start with. I hate the settlement time. But if you don't have a margin account and you only have a cash account, then this rule applies regardless. But this, along with the PDT rule, just crushes traders, and I hate it. So what are some of the workarounds for this pattern day trading rule? One is if you have $25,000 in your account. Now, if you're just starting off and you're playing around with Robinhood, or you just created a new E-Trade account and you only have like $5,000, that's gonna be hard, right? Because you're trying to make enough money to hit 25,000, not deposit more. So this is kind of hard for newer traders or people who don't have too much money to invest. The next way to go around this workaround for the PDT rule is by what they call juggling. So juggling is also not really good for smaller accounts, but let's say you have like $3,000 in your account, that would be okay, because what it does is that on Monday you will make a trade for not the entire 3,000, but you only use 1,000, and then on Tuesday you make another 1,000 trade, and then on Wednesday you make another $1,000 trade, and the funds from Monday will clear by Thursday, and that way you have another 1,000 to invest again. This is how you kind of split up your portfolio, and it will allow you to kind of make consecutive change. Now, this boils down to having good money management, account management, and it's kind of tough, especially when you have a smaller account. But this is something you just have to do in the beginning to get around it, right? One of the ways that I got around it is the next one. The next pinpoint is buying options. So I predict that a stock will go up, so I'll buy call options. And the good thing about options is that even if you're profiting a lot, let's say the stock jumps up and you're in the money, and you make your profits, you can sell it. And the difference between selling a stock and an option is that when you sell a stock, like shares of a stock, you have the T+3, so the 3-day rule that I mentioned above. But whereas options, the funds clear in one trading day and another trading day. So it's a T+1 instead of a T+3. So you get your funds a lot quicker, and options aren't as expensive, as well as you have the leverage so that you can actually make bigger purchases. Like for example, I wouldn't have enough money to buy 100 shares in Amazon, but I can do it with options for a fraction of the price. So options is a great way to work around the PDT rule. The next one is by swing trading, of course. So as long as you hold the stock overnight, even if it's just one day, right, one trading day. So you buy in the pre-market and you know this is a solid company. So you decide to hold it overnight. You know that the momentum is going to continue in the next day, especially with stocks with very powerful news and continuous press reports. Then you can swing trade. It still takes time for the funds to clear up. The T+3 rule still applies unless you have a margin account. For cash accounts, the T+3-day rule still applies. So it still takes time to settle, but you won't get hit by this PDT rule and they won't put your account on restriction. So this is really good for stocks that you believe in and more stable stocks, like for example, like Fitbit, Groupon, Snapchat, Facebook, stuff like that, where they won't crash too much overnight and you're predicting a strong gain. The next option is by doing what they call broker hopping. So this goes back to money management, and basically you would create an account on Robinhood, you would create an account on E-Trade, you would create an account on Scotch-Trade, and then you put 1,000 in each. That way you don't hit this 3-day trade in 5 days limit. Again, it's harder because you have to split up your capital, you have to manage multiple accounts, and sometimes you make a trade and you forgot which brokerage that you were using. I've tried all of these, and my favorite is definitely buying options and swing trading. So I swing trade most of the time, even until today. That's my go-to strategy for trading. I do make my momentum in day trades, but I'm more of a swing trader, and it's more profitable for me in the long term. I make better bets. So I swing traded a lot, and then I bought a lot of options, and those were my two ways to slowly build up my account past the 25,000 mark, and then get past this stupid PDT rule. The final way to do it is by using an offshore brokerage, so something like SureTrader or a brokerage that's not based in the USA and not protected by the SEC. Now, I'm not saying that just because it's not protected by the SEC that the brokerage is bad, but there are certain things like your funds could be gone and there are risks involved in that. But I've never heard of these problems with a reliable platform like SureTrader. Ooh, sorry about that. I had to pause the video real quick because I had an alert from my Thinkorswim that I clocked in another $800 in profit. So I had to hurry up and exit this video, log onto my E-Trade, and take my profits before the stock got shorted. So took in a good profit, pretty good. Sorry about that again. Anyways, back to what I was saying. So yeah, you can use an offshore brokerage, which isn't the most recommended method because it depends on the account. Now I know a lot of friends that use SureTrader, so I do recommend it, and there's nothing wrong with it at all. But I personally use E-Trade, and I have used other platforms such as Robinhood, SureTrader. I've used StocksTrade, Fidelity, and I've used everything. And I have tried juggling. I've tried all of them. But like I said, just slowly build up your account. Patience is virtue. Buy options, swing trade. That's the way to go. Anyways, thanks for watching. If you enjoyed it, please subscribe to this channel for more trading videos, more tips, and give it a thumbs up, please. You can always follow me anytime on Twitter at iswilson8, and I'll be giving you the latest stock alerts on Twitter. Thank you.